Welcome to Fintech Impact. This podcast is an exploration of the financial technology world, interviewing different fintech entrepreneurs about what they do, their story, and what their impact is on consumers, incumbents, and the industry as a whole. Here's your host, award-winning financial planner, university lecturer, and writer, Jason Pereira.
Hello and welcome to Fintech Impact. I'm your host, Jason Pereira. Today on the show, I was incredibly fortunate to pin down Paolo Sironi on a recent trip to Toronto. Paolo is a thought leader, author, and currently works at IBM Watson Financial Services in the IBM Industry Academy, and spends all of his time thinking about our relationship with money and how it's evolving based on technology and space. And with that, here's my interview with Paolo Sironi. Hello, Paolo. Thank you for coming in.
I'm happy to be here.
Well, I'm just incredibly fortunate you were in Toronto for this.
Yes, Toronto is like my second home. I've been coming so many times, and it's a great community. It's a great city. I just love to be here.
Fantastic. And you're based out of Germany, correct?
I'm based out of Germany. I'm Italian. I actually live in the two places, in Milan and in Frankfort.
Well, I do envy that. That's wonderful. Anyway, so Paolo, you work for IBM. So tell us about your role at IBM and IBM Watson.
Well, I am a member of the Industry Academy of IBM for the Watson Financial Services. The Industry Academy is a team of 100 people worldwide that create conversations with the industry in order to put together, if you like, the entrepreneurs on one side and the financial institutions, that's what they do, the regulators together with the technology providers. And I always try not to forget the individual investors, so each and every one of us, because ultimately we have to consume innovation, we have to consume technology. So it's super important that we understand how we work and how we deal with money, because otherwise we might spend time in creating new ideas, but they will never break through. So this is basically the role that I have. And in this role, I'm traveling continuously. So I'm meeting clients and I'm meeting the innovation scene in all continents, which is a great opportunity to understand what is really going on and basically to identify the things which are in common in the various areas and the things which instead are different, so they can only work in Asia, for example, they might not work in Canada or in the US. And then all of this was
cultural or also regulatory or combination?
It's both. Yeah. It's about the regulation that is creating different possibilities for the business models locally, but it's also the way people relate with money or relate with digital. If you think of China is an extreme case. So a lot of Chinese were really born digital in a completely different configuration. And so the way they use technology is different from the Western world. If you like, I like to see the world this way. In the US in particular, the technology was born, and still this is the case, largely speaking. Europe likes the regulation, which is important, and China has the business model. Now, we need to have the three of them and being capable of combining them in a proper way, because they're all important. The business model is key, because if you just have technology and you don't know how to use it, you will not break through. Regulation is fundamental, because you need to protect the investors and you need to make sure that we don't lose touch with the interest of the final consumer or the final investor. And of course, technology is what enables you now to provide better services at cheaper prices.
We have a lot to talk about. So can you tell me about your history and how you came to be where you are today?
Well, I actually started my career in banking. I was head of quantitative risk management for financial institutions, and I've been doing that for like 15 years. And then one day I decided to create my startup, my fintech. It was 2008. So I moved to Germany. And the idea was to innovate in quantitative methods by applying goal-based investing principles to extend the capability of financial advisors and the relationship managers in retail banks to talk to the respective customers, basically to change the narrative, move out of the product distribution channel and get into the analysis of the needs and the fears of the investors. In essence, it's a wealth allocation framework. And that really required the usage of API technology, so being capable of providing insights on whatever medium that the advisor might want to use in order to create a more substantiated and institutionalized conversations with its client. So that was running for like 4 or 5 years. And then in 2012, basically end of 2012, IBM bought my small fintech. So I joined IBM. And so IBM basically asked me to take this role for the Industry Academy. and to start this fintech thought leadership, which is super important because it is not easy today to understand change, to understand technology for the good and for the bad. And the financial institutions, as well as the network of advisors, needs to learn how to make the best use of that so that they can be augmented in their capability of serving the client, and at the same time, they can provide more value to the client. And if you like, this puts me at odds with many influencers in the fintech community. I don't think that technology or fintech is here to disrupt the industry. I actually think that the industry is already self-disrupting because of the global financial crisis. If you think about what happened in 2007, 2008, so many foreclosures in the US, and that crippled across the globe and affected Europe with the Euro crisis. So the regulators started raising the cost of capital, which forced the banks to de-risk their portfolios, basically to abandon high-yield relationships and focus on better quality for their credit portfolios, which meant actually to reduce the profitability of their lending operations. And also it meant that some of their existing customers could not have been serviced any longer, opening up the space for peer-to-peer lending and those type of platforms. So at the same time, the central banks applied quantitative easing, which basically lowered the interest rates to the limit. That also means negative in some countries. Think about Switzerland. So basically, there's no more meat on the bone when you look at the interest rate margin on the balance sheet of banks. So banks started thinking that they had to focus on the intermediation margin, which is made of two things. It's made of payments, and then is made of asset management and investment product, which I would call the wealth management. When I say wealth management, I have a broad definition. It means to me every product which is sold to an individual, being that individual a retail client, an affluent, a high net worth, or a ultra high net worth. Okay. Now, what is happening in this space is that on the one side, technology is effectively creating a potential for disintermediating payments through digital payments and instant payments,
that's
which
will further. We've seen the biggest push in. I mean, the most fintechs all over the place.
In essence, was one of the first experiences in the fintech ecosystem, and maybe the easiest, if you like.
I mean, that because it's even like PayPal and before that, right? I mean,
exactly. So it's nothing new, if you like. No. It's just that now can be brought to a bigger scale. And in this case, we may want to discuss a bit about what happens in China, because that's truly amazing and interesting. So that you see, if banks start losing on the profitability linked to payments because of digital payments, and they may also risk disintermediation because the clients may start using different mediums, so they don't recognize the bank anymore for the payment. Exactly. It also happens that the margins for investment management are also being squeezed continuously. And this is different reasons. In North America, it's more driven by the competition. If you like, in the US, for example, the vanguardization, so the passive investing saga. In Europe, which is more dominated by banking network, this will be driven by regulation. This year is the year of regulation in Europe. We've got 4 regulations that are getting into place. One of these is the MiFID 2, which is the regulation that focuses on the protection of the investors, that creates a higher level of transparency in the discussion between the financial institution and the investor. And by creating transparency, this might force a compression of the cost, which are basically owned by the client, and that will create a further necessity for financial institutions to find a new value proposition. So all in all, disruption is already part of the industry. Now, given that, I think the fintech innovation is not the source of disruption, but is the opportunity for the industry to transform. How is this industry supposed to change? Well, I think that this industry has to change from a transaction mechanism where you make money by selling products which have an embedded commission or fee, into packaging those products into something which is called advice that the clients are willing to pay for transparently. And this applies to both the families, business, like the wealth management operations, and the small, medium businesses, so partnership or consulting for corporate. And I think this is the biggest shift that the industry is asked to perform. And it's not easy because it really means rewiring the way the whole industry works.
With a better compensation being in place.
With a completely different compensation. Yeah. But this is the reason why I believe that wealth management, and in particular financial advice, has in itself the secret sauce to help the industry to digitize and to transform, because the business model by which an individual trusts a relationship with a professional and is willing to pay a fee to be advised in his investment decision is part of the wealth management relationship. It's not part of the mortgages business or the lending business.
Agreed. Now, question there. Now, in your mind, what is driving that transparency push right now?
Well, I think that the global financial crisis demonstrated to a lot of investors that the trust their positions into the intermediaries was not always well placed. Mm-hmm. And the regulators has to step up and basically toughen the rules in a sense, right? In order to make sure that more value is transferred to the investors. And so it's a combination of the imbalances of finance, starting from the late 80s when we had the deregulation of international capital markets, which created more volatility in the financial markets, a lot of volumes, money flowing very fast across the borders, and the need of protecting the investors way more. And I think this should not be forgotten. The first person that tweeted about my second book, The Fintech Innovation, that has a subtitle From Robo-Advisors to Goal-Based Investing and Gamification, is the founder of one of the Robo-Advisors in Europe. And he said, this Paolo Sironi has a strange point of view. He says that, he says...
Which I love because I agree with your book entirely. But
that's okay, that is a French. But he said that regulation is the engine of innovation. And I think it is in a sense because I'm not looking for disruptive innovation, which is something that lowers the margins, simplifies the products to the limit, and only works in a volume business. I'm looking for sustaining innovation, which is the innovation that enables to create an industry where value is transferred to the investors or the consumers, and they are appreciating that, they're happy to pay for, but at the same time, the financial advisor or the wealth management institution is capable of, if you like, playing that margin because at the end, they are entrepreneurs or enterprises. Now, if you think about banks have a hard time in transforming their business model because not just they have to deal with legacy systems, but they have to deal with legacy leadership. So now
they're always 5 years away from retirement.
Exactly.
And they don't want to deal with the issue.
But we go back to the point that the business model is super important, so that it is not the problem of technology these days. The problem is which is the best business model that enables both parties of this game of finance to be happy. So the financial institution and the final investor. So now regulators, by raising the bar of the playing field, are forcing the bankers to rethink the way they run the show. So now they're facing this alternative. Either they decided to become volume businesses, which may be a win in the short, but then becomes a weakness in the medium to long term, because if you become a volume business, commoditized distribution of commoditized products, basically utility, and you think of having only digital touch points, the big tech companies may come, they have many more touch points on digital with the client and they can take the business. On the other side, they have the opportunity of revising their business model. So moving from transactions, which means volumes, to services, that means added value for the client, and basically stay relevant by recreating a relationship where the engagement with the client is more important than the experience, because it's about the relationship. The value is in the relationship. Now, the point is to understand what the relationship means, because this is the essence of a successful digitization. I see a lot of guys thinking that as long as you are agile into the creation of new products, for example, the challenger banks, you can be successful because you can deploy new products in a shorter period of time. Now, the problem with this model is that it's still a product-driven business model. It's not client-centric. It is focusing on low-margin products, which needs to be taken by a big volume business in order to become sustainable and profitable.
And it's winner take all, more or less, right? Because those cost efficiencies drive down the cost to near zero. And how many players can survive?
Absolutely. Like digital has plays on both sides. It might make the cost to build more accessible, but it also reduces the margins, right? And
therefore, you have ETFs being
profits.
Given away at like less than 5 basis points in some cases because they're doing it on overnights. I mean, how much the margin's gone? Like
the zero price race is never a good race, right? And also, you see what I'm thinking? I'm thinking that I come from risk management. And now, managing and reducing the cost is always important, but the cost can bite your sandwich while the risk can eat your lunch. So the problem here is to make sure that the investor understands what he's doing with his money through the cycle because, things change in his life. There is an instability of the investor that you need to take care of, and things change in the financial markets. There's an instability of financial markets that you need to factor into your decision making. So that if being a volume business doesn't give you an advantage in the long term, the alternative is to being capable of digitizing the relationship. So what is the relationship? The relationship is about knowledge, because trust is knowledge, because that's the way people basically think. And actually, I think that this is what Silicon Valley did not really understand when they started looking at fintech and banking.
When the likes of Wealthfront comes out and say they're looking to put all advisors out of business, I think you're right. Like I often said, it's the old analogy, when you have a hammer, everything looks like a nail, right? They think they can automate away all humanity to some degree. Not everybody, but many of them.
Not everybody.
But the reality is that the human interaction is absolutely of value, and having someone deal with all the immensity of what is becoming the fintech space and understanding how to translate that into the relationship.
Now, let me say that there are, if you like, parts of banking which can be more easily digitized as a product mechanism. But absolutely. As we just said, those products are losing steam. So the digitization of those product channels won't take you that far. Now, the question is, how do you digitize the most important elements of banking, which are the relationships that lead banks to generate value by selling investment products and insurance products. So the reason why Silicon Valley misunderstood these industries, because they thought that the same psychology forces that motivate the consumers when they buy products on Amazon equally applies to investment products and insurance products. In reality, digital is what I call a pull technology, while investing and insuring works in a push economy. That means digital is demand driven, while investing and insuring is offer driven. This is an offer driven industry. How can I explain it to you? Let me give you this example. I actually live in Frankfort, as said, and my family is in Milan. I live in both places. So every weekend I go back home to my family. And my role is to do the groceries. So every Saturday morning I got to do the groceries, right? So I go to the supermarket, to the mall. And I want to be very fast autopilot. I don't want to waste time. So I start pulling from the shelves the things I need. I pull my milk, I pull my bread, I pull my pasta. And then I may see a different product, maybe a shampoo that is advertised by someone famous and is pushed at me. And I may decide to change my consumption habit. But in reality, for the majority of the things I do, I go with a purpose. I pull from the shelf. Now, you, Jason, never told me, Paolo, let's take a look at what is going on Amazon, right? You go on Amazon with a purpose because you want to buy one of my books, maybe the Fintech Innovation.
The aisles at Amazon.
Yes. Well, that is, we get into the topic too, because that is very interesting and it really matches this example. But you see, you go with that person and then maybe you change your mind, but you're motivated by your demand because you know what you want, or more or less you know what you want. But very few people will go on Google and start Googling if there is a UCTS fund that is investing in Canadian stocks, 30% of this allocation, and between 16 and 18% in Chinese stocks out of Shanghai. It doesn't really happen. No. People typically, the majority of people, are not self-directed. They have some money, they have some needs, and they want to talk to someone because they need to make a cunning financial decision. So they need to somehow share the burden with somebody else. And this is where the technology and the psychology of the investors are basically differentiating themselves. So digital is pull, demand, while investing is push, is offer driven. If this is so, some people may think, okay, so we don't have to worry about the Robo-Advisors. We don't have to worry about the technology because you will never be able to replicate these engaged relationships. But I don't think they're right because something is happening. Artificial intelligence basically is becoming more and more conversational, and we see it every day. So the moment artificial intelligence becomes fully conversational in the consuming world first, and then in finance after, then digital technology will go from being pull into being pushed, and the circle is closed. And this is also important to me because it explains what happens between fintech banks and the tech giants. Maybe we see it more clearly in China, but I think it's something that we need to discuss in the Western world as well. So a lot of guys say, watch out because Facebook or Amazon, they want to become a bank and basically they will be the winners. Now, I don't think that these guys want to become a bank. They would be crazy to do that,
They're not used to regulation on that
level.
they're
not used to, but also banking is really a disrupted industry. It's going through a huge process of transformation. But the point is that something is happening in their ecosystem which might force them to get into banking. So the reason why they're getting into banking is because of competition in their ecosystem. Let me explain that to you this way. So Amazon decided to sell Alexa to the American families. So basically, Americans can have Alexa in their lounge. And what do? They can start now buying things through Alexa. You remember, right? So maybe do the same. But now Amazon just didn't do that. Amazon also bought Whole Foods. Now, what do basically every week? You do groceries, right? So this is the thing that you do more often in your life in terms of spending habit. Now, the moment you get used to ask Alexa to buy milk, because now Amazon has a distribution network of perishable goods, you may be hooked into what? Into using voice as a mechanism to perform your purchases habits. So now voice is the new marketing, or that basically what some of the guys think it might well happen. Because voice operates at the last mile level. It's like when you make the final decision, you talk to somebody, like when you go to a store, right?
There's no translation factor between my thought. It just pours out versus
exactly. So now we're not there yet, right? For AI to be so powerful. But
Siri testifies that we're not there yet.
Exactly. But we are starting, right? Yes. So you know that at some point technology starts growing very, very fast.
Absolutely.
So now, if this is so, let's discuss Facebook. What is Facebook? Facebook is a social media platform for me and you, Jason, but in reality is an advertisement machine for Mark Zuckerberg. So now, before the Cambridge Analytica story, Facebook had another problem. Mark said a month and a half ago that they wanted to change the algorithm to make Facebook more relevant. Why? Because they noticed two things, that the population of their users on the platform is getting older. So basically, young generations are not using Facebook like my generation. And then my generation is not that engaged as before. So basically, people post a bit less. Even though they may use WeChat and Messenger way more, they post on Facebook a bit less. Now, if this is so, it means that Facebook might not be able to price their marketing more so effectively like in the past. Now, imagine the story. Voice becomes the new marketing. You are on Facebook, you see a product on Facebook, but typically you don't buy on Facebook. You go to the store offline or you go on Amazon. Now, think about a corporate. Where would they put the marketing budget if voice becomes the new marketing? On Alexa or Facebook? They may be shifted to a different mechanism, which they don't own. So that means that Facebook, to me, has to look at payments. Why? Because in China, payment made WeChat and Alibaba, the giants that we know today, a completely different experience, because paying is super engaging, even more than posting your pictures, because you have to do that anyway, like it or not.
And it's interesting, though, because, I mean, when that relationship changes very differently compared to, say, Googling for something, right? Because when you Google something, you get a list of options, right? If I say, I want milk, or I want, let's just extend it to, I want to buy a moderate risk portfolio, you don't expect the AI to respond with, here's a list of 20 things, right? You want the one answer.
You get into a conversation, or basically you may want the answer with an explanation for that answer, because then we need to discuss a little bit the difference between cognitive and artificial intelligence. But now, just to complete the discussion around Facebook and Amazon, the moment Facebook enters into payments, what happens to PayPal? Now, Facebook might have a bigger client base than PayPal, and maybe can even be more powerful because, you don't go on PayPal every day, right? But you are continuous on Facebook. So this is the experience of the Chinese guys. So PayPal announced a couple of things this year. Announced that they will put Acorn, which is an Australian robo-advisor, on their front end. So now you can move from paying into investing directly. And a few weeks ago, they said that they're going to launch core banking. That means credit lines and credit cards, so on and so forth. So basically, I think that what the competition between Facebook and Amazon is forcing the other player to move up into the value chain of banking, moving out of pure payment systems and digital payments and get into digital investing, and then maybe one day will be digital insurance, so on and so forth. So this is what is really happening. And this can be more transformative than fintech themselves, because these guys have the capability of explaining to the consumers or to the investors their value proposition way more than small startups, because acquiring a new client on digital is fairly expensive, because we just said that there is a psychology of the investor which is different than the psychology of the consumer, which creates the asymmetry of information, which is also the reason why when powerhouses like Vanguard or Charles Schwab launched the Robo-Advisor, they can acquire a bigger amount of asset under management, because they can talk to existing customers that they are already trusted partners, and they can basically lure some clients into the new mechanism. And so these tech giants might well be able to do in the future. But that means that if financial institutions consider and conceive innovation like a commoditization exercise, they are going to fail in the medium to long term, because if they self-commoditize themselves further, the tech giant have more digital touch points with the clients they can exploit. So that means that financial institutions needs to learn from financial advisors whose business is primarily based on relationship between individuals, in order to see how they can augment the capability of these guys to scale. Because the margins are going down for everybody, even for human advisors. But the way the relationship works there is the one that needs to be looked at, so that once you have it at the center, all the other products, which are the mortgages, the loans, the payment, will become functional to provide value into this relationship.
But there's an interesting dichotomy there, right? Because the digital side scales indefinitely, whereas the human one-to-one side with advisors doesn't, right? Like, I mean, statistics like the Dunbar number that limit our ability to have deep relationships to more than 150. I mean, you look at a lot of advisory practices around the world and you see, 1,000 to 1 advisor ratios or 500 to 1 advisor ratios. I think that this kind of bodes for a trend I'm seeing elsewhere, which is those relationships need to become deeper and broader, but it's going to be with fewer people in general.
So let me say, what is the product or the solution that justify the fees in the investment management relationship? I asked this question a few guys recently, to Yves Perrier, who is the CEO of Amundi, the 7th largest asset management company in the world, trillions of assets under management. And he said his advice and ongoing advice basically is the relationship. Now, how can you scale the relationship? Well, I think that you need to conceive an O2O type of mechanism, which is online and offline, so a hybrid model where the technology enables the advisor to focus on what most matters to him and to the client in the relationship, which is the onboarding, which is continuous onboarding. It's like the wealth allocation framework. Is what some guys call the gam of advice, while technology can take care of two things. So one is the investment solution, which is more and more commoditized. In essence, there will not be much differentiation there. And also the capability of the client to self-direct himself partly to create an experience which is offline when he wants it and he wants to get more informed, but enables him to contextualize that conversation and knowledge together with an advisor who knows what the client did when he accessed the digital solution. Now, what is the turning point here? The turning point is the use of artificial intelligence to do what? Not to replace the relationship, which at some point, might even happen in some industries, but to augment the competences of people into this relationship. So augment the competence of the advisor to provide substantiated information to the client and augment the capability of the client to start relating with digital in a way that he doesn't feel scared, but he feels more reassured. But it is important that the two elements are basically linked, because there will always be for a long while a human element into this relationship. And this is the reason why some robo-advisors started hiring human advisors like Betterment in order to move the relationship forward, because it's important to have a foot in the offline world. You cannot just operate in the online world. Even Vanguard is absolutely is a hybrid model. So, I think the industry might shift. We said AI might become more and more conversational, but there's a long way to go. For the time being, there's a huge power of AI to help individuals to institutionalize or industrialize, if you like, a bit more the relationship and the narrative, so that they can relate with people and help people to relate with their goals and their personal issues. It is also difficult to get the trust of your clients and be told everything about the client's financial life and situation. But the client may be inclined to have conversations with you on some part of the business and their problems, and then being self-directed as a way to aggregate, on their whole wealth allocation framework. So if he likes the conversation, he might be inclined to use a tool where he adds more information, but he uses your narrative and your language. Absolutely. And that creates a reinforcing mechanism where he might start trusting you a bit more at a time, so that locks in the relationship.
You don't have to make the big relationship leap from day one.
Absolutely.
They can ease their way into it more
Absolutely.
effectively.
But that's the reason why, if you like, IBM never used the word artificial intelligence to define Watson. We always use the word cognitive, because cognitive means that artificial intelligence is just one piece of the game. There are other pieces that need to be respected. So the cognitive experience and the cognitive engagement is really what matters. So
that's such an interesting message coming from like the company that built the machine that won Jeopardy. Like, I mean, a lot of people are terrified by this concept. You know, Elon Musk's the biggest detractor of it. But to hear that you guys are looking at it from a framework of an overall larger scheme than just the AI.
Our CEO defined ethical standards for the usage of AI. And she said many times that A stands for augmented intelligence, is not artificial intelligence. So going back to the question that you posed me before about Google, the point is not just to tell somebody, this is the answer. That's not cognitive. That's not augmented intelligence. That's not Watson. Exactly. The point is understanding the answer. That means transferring knowledge to the individuals so that they are motivated to act in a way that they understand the reasons why they made a decision more transparently. So this is value which is transferred to the individual. And honestly, I think that this is exactly what a good financial advisor does today. It helps his client not just to trust him, but to understand the decision that they decide to make or he decides to make, so that when the financial markets unfold their ups and downs, the client understands which were the risks and the potential returns that he was embarking into this relationship.
It's kind of similar to how I see the way I do my job. Basically, we try to distill everything down to very simple terms or very simple presentations for clients. Very just, here's what you need to know. But then they're always encouraged to know that, hey, if you need to understand beyond that, we're going to explain the basics of it. But we can go deeper, because really behind this very simple distillation process is this enormous wealth of knowledge that we have based this all on. And we can let the client determine at this point how deep down that rabbit hole they want to go towards understanding. I mean, what you're talking about is very similar, just I think more intuitive, because it learns the degree to which people want to know.
Yes, but there's even something more important, because when I say knowledge, I don't really refer to financial education like some people define it. I think about financial behavior. That's why the last section of my bestseller, Fintech Innovation, is dedicated to gamification. Basically, how to help people understand how they relate with money and how they react on the financial markets. Knowing in details what is a hedge fund, what's a derivative, would not help anybody, not even the traders. The point is, how do I face risk and how do I face uncertainty? Now, that means that it's not just a problem of making sure that the financial institution and the advisor is a trusted individual and works in the interest of the client. It's also a problem of making sure that the clients understand that this value proposition, because a lot of clients have a hard time in understanding this because they have cognitive biases. How do I explain this? I would do it this way. Most of the clients go to an advisor or a bank thinking that they pay money to buy performance. And this is wrong, because what they really buy is risk, because nobody owns it. So then the advisor of the bank might know that, and sometimes they are not inclined to explain to the client, because the client, might be scared, they would not understand the story. Or the client may think, you know what, I've got a friend working for this, well-known financial institution, and they tell me that there is this product that can give you that performance. So it's very difficult, because individuals are also greedy. Generally speaking.
Yes.
But now, the meta truth on top of this truth is that the client doesn't really buy neither performance nor risk from the advisor. What he buys, in many cases, is the comfort of making a financial decision. That's why he needs to get into a conversation with someone, because that conversation generates trust. Now, if the advisor is good enough to transfer real knowledge and behavioral knowledge to the client, that creates stickiness through the cycle. So the client smooths his anxiety and his tendency to overreact on the financial cycle, because he goes back to the real motivation for his investing, which might be the long term or a defined goal. If the advisor is not capable of doing that, the client would only entrust him because he thinks that he knows more, but that doesn't really transfer value. So the moment that the market gets into a downturn, he will have a lot of troubles, because that's when you have to work the most and get less of the money because it's linked to the AUM, right? So this is a crucial element to enable the advisors to scale, because they can transfer knowledge, behavioral knowledge to the individual, and therefore also enables the banks to transform the business model to create a new business model which is resilient, right? That can be industrialized, that can be used by people which are augmented in their capability to have a proper relationship with the clients. In essence, not everybody can be a good advisor, but maybe technology can help to level up the playing field so that more individuals can transform their work, which now is linked to sell products, and they might be enabled now to sell more substantiated advice, being reassured that they're also guided through this process. Then, like anything, technology is not neutral in the sense that you can use it for the good or for the bad, right? So it's left to the individuals and to the corporations to make sure that this is always done in the best interest of the client, because that creates value in the long term, which is in essence sustaining innovation.
That was a lot, but that was fantastic. I want to go back to a couple of the points you made earlier. First of all, you mentioned what's going on in China, and you wanted to come back to that. Can we go down that route?
Well, as I mentioned before, let's say the US, I said, is where the technology is broadly speaking. Europe has a sweet spot on regulation, which is very important, but China has the business model. Because what happens in China is extraordinary. China was walled off from the Western world, so that you don't find the Amazon and the Google and the Facebook there, but you find all sorts of different social media platforms. But in particular, you find companies like Tencent, that is the owner of WeChat. WeChat was a conversational app, basically the equivalent of Messenger or WhatsApp. They added payments and they became a powerhouse. Because basically they have 1 billion customers that use WeChat on a daily basis in order to basically connect all of the elements of their daily life. Now, why does this matter to me? It matters because in the fintech community, a lot of guys discuss about the idea of the customer experience. So they say, okay, maybe Paolo is right. There is this pull and push mechanism. There is this cognitive bias on the client side. But you know what? We have such a wonderful customer experience that all the clients will want to work with us, because it's amazing what they can do with a phone.
Right? Awesome. Yeah.
Now, what WeChat shows is that the customer engagement is way more important than the customer experience. And the reason is because the customer experience can be commoditized very fast. It's like the Wi-Fi in a hotel. 10 years ago, I would have chosen the hotel because of the Wi-Fi. Now it's common practice.
It still sucks no matter what you do.
But, yeah, sometimes, But I went actually in Nice a few months ago, and then there was no Wi-Fi in the hotel. But, in France, they have La Côte d'Azur, so maybe you don't need that. But in essence, what happens here is that imagine that you now provide a solution which enables you to do instant payments or open a bank account in 1 hour instead of 10 days. Sooner or later, everybody will do that, right? So that can get commoditized very fast. What cannot be commoditized that fast is the relationship, once more, which is the engagement. The engagement is something that invites you to do things and to come back continuously. So basically to be not really entrapped, but if you like, to create a stickiness between you, your platform, and your customer. Now, if I compare WeChat and Facebook, I'm always selling my books, the Facebook experience is much nicer to me. The pictures are larger. I can trim the videos. I can do many things. On WeChat, there's way more mechanical things that I have to do when I post the information, when I put my links. But what I can do on WeChat is amazing because I can connect all of the elements of my daily life. I can book an appointment with a doctor. I can book the restaurant. I can share.
Renew your driver's license on it.
I can do everything, basically, right? So that makes sure that it doesn't really matter what happens. WeChat stays with you on a daily basis and hooks you into their relationship. Now, WeChat, these Chinese platforms are the biggest distributors of investment fund in the world these days. And WeChat did something very interesting at the beginning of this year. They got a license to sell investment funds directly. So they used to be a platform that was aggregating, if you like, other apps from third parties and fintechs so that they could participate to this ecosystem and basically engage the clients that that are a client of WeChat on their platform. But now WeChat can also, if you like, insource those relationships by selling directly to the clients. So soon they may even be able to generate these investment funds, which typically speaking, they are acting like passive investing vehicles. So now this is the transformation that we see in China that we don't see in the Western world. But we also have to say that China has a different regulation, is a different marketplace, and not everything that shine is gold. So now we need to make sure that we learn from the Chinese experience, but we do that in a way that the consumers and the investors are way more protected in terms of privacy, in terms of their capability of being augmented to make conscious decisions, which means that the Western world needs to look and has the opportunity to look at sustaining innovation once more instead of looking at the disruption. Do you know the difference between sustaining innovation and disruptive innovation?
I'm going to, if I attempt it, I will screw it up. I'm going to let you tell me.
So basically, it goes this way. The disruptive innovation is when an industry is saturated. Mm-hmm. So basically, you don't understand the value proposition of your provider of services or products. So somebody comes with a cheaper product that is simpler to use, and then you like it and you buy it. It doesn't mean that it is better than the product before, but somehow...
Back to the innovator's dilemma, Christensen's thinking.
Exactly. Yes. But then... all of those companies that forced disruption into a market stayed relevant 10, 15 years after this. They found a way out of disruption to go back to sustaining innovation. That means you improve your product, you invite your clients to buy the new version and more sophisticated.
You ladder up the value chain.
Exactly. So you get more margins. Now, I can explain this to you comparing the iPod and the Robo-Advisor. So when 25 years ago, my father came home with a CD player, I used to listen to music with the tape recorder. You remember that?
Yeah.
You're my age.
I'm still that old.
Right? So now that was a piece of sustaining innovation. I was fortunate that Dad could afford it because I think it was something like 1,000 of today's Canadian dollars.
Wow.
And every year I was buying into a new piece to build the hi-fi I had in the lounge. I bought the equalizers, the loudspeakers, the subwoofer. But I got to the point that I didn't know what I had to buy next to be satisfied to improve the quality of the music I was listening to. You might have done the same thing. I bought fiber optic cables.
Oh, yeah.
Those
were so expensive. Like super $50 cables.
Exactly. Yeah. And I thought, God knows, what type of quality I'm going to get out of my hi-fi.
I think I hear a difference.
Right. Now, I saturated. I didn't understand, why I had to basically spend more money to improve it. Think about a bank before the global financial crisis. You had this open architecture that had a lot of complex products on display. You had the subprime securitizations fund, the target fund, formula fund, hedge funds,
created a risk management framework,
derivatives, global options, whatever else.
Yeah.
So let's say that the clients stopped understanding, put it this way, the value propositions at the height of the global financial crisis. So now that's when, if you go back to the music industry, Steve Jobs put iTunes on the Mac and started disrupting the music industry forever because the iPod was not better music compared to my hi-fi.
No,
but it was like 200 Canadian dollars.
It's still it was originally probably more. No, I have a second generation iPod and I think I bought that used for $800. So that was not a cheap Canadian dollars. I think it was close to $1,000 also for that initially, the first one.
Well, the first, but when the moment they decided that there was a mass market, right, they went viral.
Oh, yeah.
And so, if you like, that is when disruption occurred, right? And even today, so if you like, people are not listening to music using iTunes, they might use Spotify or something else, but it transformed the industry. Now think about the Robo-Advisor the same way. The Robo-Advisor is not necessarily a better solution that a personal financial advisor or planner. In some cases it is, I think it is, and in some cases it's not. I think it's not. But the point is, if the investor does not understand the value proposition of the bank or the financial advisor any longer, he might be inclined to onboard on a different solution, which is more frictionless and simplified and more immediate to them.
Some of them allow you to onboard with a single dollar. So, I mean, it's accessible to everybody as well,
exactly,
very democratized.
But now, think about the iPod again. If you go to the Apple store, you don't find the iPod anymore, right? You find the iPhone, which I basically bought. So Apple didn't make $250 billion cash in their coffers by selling examples of disruptive innovation. But they moved again into sustaining innovation, selling products which were of more added value. So that's what the banks need to learn to do if they really wanted to digitize and to go through the disruption phase. But what is sustaining innovation for banks, therefore? Well, to understand that, I think we need to come up with a different example, which is not Apple. There is a company in the world that basically tries to move from a status quo, which is already fairly sophisticated, into a higher level status quo without going through disruption. That means simpler and cheaper products. And that company is Tesla.
Yes.
Because Tesla, was not really born as a cheap car and immediately, appealed to a certain type of individuals. But Tesla,
it also defeated the concept that electric cars were going to be these like rinky-dink little things that no one's going to want to buy.
Now, don't misunderstand me here. The play of Elon Musk is very risky, right? So it's usually risky, right? I'm not saying
all
that.
The debt he has, yes, I agree.
When we discuss innovation, it might work or may not work. So we will see what happens with Tesla. But Tesla is built around the two key elements: an engine, which is an electric engine, different than before. Some people say it's not even a car maker, it's an electric battery provider.
Absolutely.
And analytics that help you to drive Tesla in a different way because it gives information, smooths your driving. So now think about a digital banking platform. This digital platform needs to be powered by a different engine that enables you to aggregate a lot of relationships and decision-making processes, to digitize knowledge and motivation. That is what you do when you make a decision, because you need to understand it better. But then you need analytics in order to convey that message and that understanding to the individuals,
so
which is artificial intelligence.
Yeah. Same way they basically upgrade the autopilot on a regular basis based on what they've learned. We need to create a digital framework for banking whereby they can take an analytics, see how we work with things, and figure out how to better improve that relationship over time.
Right, but if you like, it is important that everybody understand their customers more. But the top priority is for banks to make sure that the customers understand banks. The same is the advisor,
Absolutely.
right? So that is the first and foremost thing that augmented intelligence can help you doing. It can help you basically getting closer to the client, because you can create a digital experience where he's engaged and he can start playing with you on a certain topic and basically feel like is really empowered by making decisions. That transfers behavioral knowledge. That's why the concept of gamification is so important for me, because it's a way of transferring skin in the game to the individuals. Now, skin in the game is a very cool concept, and I love Nassim Taleb, and I should not talk about it because I have due respect for his amazing work. But I think that we cannot just confine this conversation to the level of the traders and the hedge fund managers. The point is, how can we help individuals that need to invest in order to learn skin in the game? That means making sure they understand the risk involved in terms of risk taking. Now, maybe traders should, and people with money can basically afford to make mistakes, but many households might not be able to afford that. Now, making mistakes doesn't mean that you lose money on the capital markets. Making mistake means that you don't know what the heck you're doing, right? So you're not, if you like, aware of the consequences of your financial decisions, which, if you like, is the amazing value of a good conversation between a client and his financial advisory partner.
It's interesting. Just one of the thoughts that always comes to my mind when we talk about gamification anywhere. And it always goes back to the fact this has been going on for a much longer time than basically the digital realm. And I always think back to this one story I heard about when Napoleon created the Legion of Honor. And basically someone asked him, why are you bothering with these things? These are just little baubles and trinkets. And his response was, yes, but men will walk to their death in order to get them, right? And it's basically, and you look at that, that's basically the entire thing we created with gamification. Like, you get a badge for finishing your day on, Apple Health, big deal, because you have your Apple Watch, you closed all 3 rings, but those things lead to an action. And I think that the power of that, making sure that is aligned with the actual best interest of the client, is going to be super powerful in the next decade.
You see, gamification can be used in different ways. One can be to profile investors, because you can give them a dry run where it will never be like the real life, but it's better than questionnaires, right?
So the simulated trading portfolio, but now you actually
it's like a dry run, right? So maybe it should be compulsory, like when you get a driving license for everybody. But again and again, because it's not based upon normative knowledge, it's based upon an experience and an engagement relationship, where on digital you can gamify what can happen when you make financial decisions, so that you start learning that it doesn't really matter how cool you are and knowledgeable you are. If something happens in the market which is unexpected, which is uncertainty, can be like Twin Towers, for example, right? So the market will go down anyway, right? It doesn't really matter how smart you were as an advisor, right, with your financial analysis and so on and so forth. And people always forget that this is also a play. But also goals are part of games because you play a game because you want to reach a certain goal. Exactly. And as you play, you go through different stages where you're more and more engaged. It becomes a bit more complicated. And then you are fulfilling some of the previous goals and requirements until to reach the final destination. Let's say that your final destination is retirement, for example. Yes. Right? Because it is. Mm-hmm. It's the ultimate goal. You have to make a lot of decisions before in order to make sure that you retire with comfort. You need to learn how to save. You need to learn how to invest. You need to learn how you insure. You need to learn how you lend and borrow, donate. Now, the personal financial equation is the core of the client-centric digital platform, which uses gamification as a way of helping people to understand the relationship about all of these elements. And it's a very simple equation. It goes this way. I make money because I work for IBM, minus what I pay, digital payment, equals what I save. If I'm smart in saving, I can invest, I can lend and borrow like on a peer-to-peer platform. I can donate, I can retire, I can make insurance. The equation is very simple, but I have a problem that I don't have enough money to do all the things I want to do. And as I age, I go through my life cycle, I change priorities. Now, it is so important to help people not just to optimize any point of these any element of this equation, right? But should I basically accumulate and then decumulate or buy healthcare insurance because maybe my priority after I retire? You know, the decision may be different for the variety of people, because of their wealth allocation, basically, right? And what they have somewhere else inside their wealth framework. Now, the key element is that big data operates on the left side of this equation because digital payment is there, but all of the added value relationships that are conveyed through products are on the right side of the equation. So the question is how you learn from big data in order to help people to make decisions on the other side of the equation by following what they do every day, but not just to do marketing, but to invite them to think more or less continuously about the impact of their daily decisions or the weekly decisions and monthly decisions on their future and long-term outlook. Next week, I will open a symposium at Wharton School in Pennsylvania on retirement, basically the impact on fintech on the retirement problem. And I think this is of utmost importance because of two reasons. Because the next global financial crisis might be triggered by retirement at this time, because our retirement system is very unbalanced everywhere in the world. And that also because that will create a need for people to think about the long-term investing, starting from the early days of their professional life. You know how difficult it is to discuss with your children when they are 18 or 20 years old, the fact that they need to save money as well, thinking for retirement. But once, unfortunately, the need will be more apparent, that will also create the need for people to receive financial advice and financial planning. So basically, I think is opening up an opportunity for the financial advisors to deep dive more into the planning exercise in order to help households to self-direct themselves a bit more. Now, the fact is that the planning exercises are very expensive, or typically they're expensive, not for everybody, requires time. Absolutely. That's where fintech can help, because should facilitate to lower the access cost into this relationship that helps you to make cunning financial decisions, that enables you to go through this game of finance and game of life, where all elements of your life are part of your financial equation, and they need to be basically balanced carefully and, if I would say, consciously.
So we're going to have to wrap up. We're nearing the end of our time. First of all, this has been fantastic. Thank you so much. Before we go, I wanted you to give you an opportunity to plug your books. So you have 4 of them. Can you tell us about them?
The first one is a portfolio management book because I wanted to address it to quant finance. And is at the heart of everything and the engine that motivates and generates goal-based investing, because it's Monte Carlo simulation over time. So basically it tries to create an heuristic, which is a what-if analysis that enables you to do, if you like, ongoing advice. That means the optimal portfolio that I discussed in my first book titled The Probabilistic Scenario Optimization doesn't really exist, even though I discuss about that, because the moment you optimize a portfolio, it is suboptimal, right? Because market conditions changed. Yeah. But the key element is that you need to optimize not portfolios, but investment decisions.
Yes.
So in order to do that, you need, I believe, to play with the heuristics. So what if analysis that helps the client understand what if I do this, what if I do that, which are the consequences. So it might be suboptimal in mathematical terms, but you play with mental accounts, which is the way you can convey most value to the client for decision making.
I'm a big believer in goal-based planning. We've been implementing.
Yes, so that was the first. The second book is Fintech Innovation, which is very successful. It's published by Wiley. The subtitle is From Robo-Advisors to Goal-Based Investing and Gamification. It is more accessible. It has elements of quant finance, but not much mathematics. Explains what the Robo-Advisors are, but pulls the lens out of commoditized investment solution into goal-based investing, and explains why, even though most of them started as a B2C mechanism, business to consumers, they would have ended up into business to business or business to consumers, which is what is happening these days. Yep. And also discusses the robo-retirement, which you like is the ultimate element. Planning is more important than advice on commoditized investment solutions. Venture capitalists may not understand that because they think volumes. So they think the model portfolio is volume. But in reality, the real value is in the planning exercise. And then the third book was just released a few months ago. The title is MiFID 2, Value Generation for Investors, and really wants to answer this question, which is the product and solution that justify the fees. Now, the onboarding of the client, that means the understanding of his needs, goals, and the wealth allocation framework is will justify the fees. The investment solution is super important because it's how you transform the onboarding into an opportunity for investing the money. And the circularity between the two, which is an ongoing advice, is what basically generates over time the engagement in the relationship and keeps on transferring knowledge from the advisor to the client. And in some cases, even building knowledge together, because knowledge is not just about what happens in the financial markets. Knowledge is also about what does it mean for me as a client, right? What is the value and the meaning of money for me as an individual? And we're all different and it's never the same. So this third one starts from European regulation, the MiFID 2, because I wanted to get the opportunity to showcase that we are talking about innovation in finance, portfolio theory, moving out of modern portfolio theory into scenario analysis for the long term. I'm discussing fintech innovation, artificial intelligence, robo-advisors, but in reality, these are not abstract concepts. Regulators, at least in Europe, have something in mind. They want to help the industry to transform into a more transparent and substantiated exercise. So now, that means that any money you spend on compliance, you can also spend in making sure that you reduce the cost of compliance by changing your business model and being more apt to be an institution that thrives and stays relevant in 2020, 2025, when digital will be even more common in our daily life and the big tech players might want to start playing the game of finance. It's all about the value generation for investors.
Fantastic. Paolo, thank you so much. This has been very enlightening. I've spoken a lot less than I normally do because, frankly, I wanted you to keep speaking. So.
Look, for everybody interested, they can go to my website, thepsironi.com. It's like the Financial Times. Okay? Yes. And I got all links there.
Excellent. Thank you again. So that was my interview with Paolo Sironi. I hope you enjoyed that. We went longer than usual, as I said, and frankly, there was a lot to digest there, and I think it was fantastic. So I'm very happy with how that interview worked out, and I hope you enjoyed it. So once again, as always, if you enjoyed this podcast, please leave a review on iTunes, Stitcher, wherever it is you get your podcasts, and please take the time to sign up for our newsletter at fintechimpact.co. Until next time, I'm Jason Pereira.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at fintechimpact.co.